Hey, good morning, everybody. Hope your Saturday's off to a good start. Today, I'm traveling this week, so might be a little shorter than normal. I'm going to start off with just some housekeeping stuff, and then just jump into some slides that I got. Questions from you all. So I appreciate the questions. Please keep them coming. That's how, basically I try to drive a lot of these presentations. It's also stuff that I read or watch videos or all that kind of stuff during the week. But anyway, the housekeeping stuff, just to kind of bring it up, I've mentioned this in the past. TD Ameritrade, where we custody assets at, was purchased by Schwab years ago. I think it's probably been 3 or 4 years now. But they've slowly been migrating over. But they are going to move the TD Ameritrade institutional, so not the retail side, but the institutional side. So all the advisors that work with TD, they're going to be moved over to Schwab after Labor Day. So, you leave for your Labor Day weekend, your accounts are at TD Ameritrade. You're going to wake up Tuesday morning and they're going to be with Schwab. So I've been looking at alternatives to Schwab. It's not that I don't necessarily like Schwab. I mean, it's a huge custodian. I think it's probably the second or third largest in the country. There's a lot of good things about Schwab, but they typically don't treat advisors. They've always been more of a retail side, and they don't treat advisors as well. TD Ameritrade kind of built their practice to work with advisors and really cater to us, where Schwab never really did. And, Schwab never put any money into internal tools for advisors. The other thing is Schwab tries to compete. They have their own financial planning arm. So I was with a firm when I first started my career, and we were Schwab, and they were literally just marketing straight through our clients. But the other thing is that I noticed when I was at the firm that was with Schwab, the service wasn't very good unless you have $1 billion in assets or more, unless you're a really big player. They don't really cater to you. And they're telling us, oh yeah, we're going to be great for you guys. We're committed to, we purchased TD Ameritrade. We're committed to this. So we'll see. So either I need to move everything before September, or we're just going to migrate over, and then we'll see how it goes with Schwab. So right now, I'm probably going to just migrate over. This could change soon, but I've looked at other platforms. Some of them I really like. Some of them I don't think that's a big step up from Schwab. So I'm not convinced. Nothing's really jumped at me like this is way better. There's one that's really kind of up and coming, but it's still missing a few key ingredients that I would love to see, both from the aspect that you would see, the portals and things like that. But then also the back end tools for me to manage everything. But they're getting close, and they do make things a lot easier, and they've got it structured where you can do a lot more yourself. As far as if you need an ACH distribution, or you need money for the month or a little extra or whatever, you can do all of that yourself if you want to, and it's pretty simple. But at least right now, I think I'm going to let the migration move to Schwab. That doesn't require any new paperwork for you all, which is good. And then they say that all the different little, if you have money coming out of your accounts to your bank account, all that stuff is supposed to be seamless. And I'm going to say, supposed to be is the key phrase there. So we'll see. Hopefully it works fine. But another big reason I'm going to probably migrate over is I'm sort of looking. I'm also kind of looking at the future for me and my firm. And one of the big things I'm looking to do is to latch on to a much bigger firm. And then I would still be like Picket Fence Financial, or doing business as Picket Fence Financial, but I'd kind of have this back end firm that would do all the admin work, a lot of the compliance stuff, a lot of the routine things that, I end up doing that really don't add value to you all. So I'm looking at that as an option. And the big reason I've had employees and things like that. And, it's really difficult in today's world with employees. I've had, people I brought in, and it's not like they left for more money or they didn't enjoy working there. A lot of them went back to to their old career or to another career. One pseudo retired. She got married. So it's just things like that pop up. And then when that happens, it means I've got to step in and do more work. So if I just have a back end that I know is there, I don't have to worry about any of that stuff. So I'm either going to go that route. And it's also good, I think, for you all, because then you've got, a very large firm backing me. So if I get hit by the truck or anything like that, you've got something there, to kind of carry it on. The other path I'm looking at is to kind of create sort of a back end. The tool I mentioned that I think is pretty close to being really good. We could build off that platform with a couple other softwares that they're integrated. And then I've got somebody I interviewed 3 months back, I guess, 2-3 months back, Cale Smith. He talked on oil, but Cale was a classmate of mine at the Coast Guard Academy, and he and I were also roommates. After we got out of the academy, we were both stationed in Hawaii. So I've known Cale for a long time, and absolutely one of my best friends. And so he's got a money management firm, and we're just looking at building something that way. And we let other advisors onto the new platform. But we really vet them well. Like we've talked, like maybe only having service academy graduates, or absolutely people who maybe smaller fee-only firms that want to build up things like that. So looking at a lot of different things for my firm, and then what I'll probably do is do the migration to Schwab, and then try to make heads or tails of what I'm going to do. If I go with some of these bigger firms, if I go that route, they all have relationships with Schwab. So I could probably stay at Schwab. And the other nice thing is, like, both firms I'm looking at and I'm talking to, they both have more than $2 billion in assets under management. So they're kind of at the top tier with Schwab as far as service. So, I wouldn't be the little guy getting the horrible service anymore. You get the top tier service. So I'll keep you abreast, but I just want to keep throughout the summer. I'm going to talk about this migration just because it is coming up fast. We're less than 3 months away. And I want to make sure, like when you wake up, I know the week after Labor Day, I'm going to get calls from people and they try to log in a TD and there's nothing there. Their accounts are zeroed out. I don't want anybody thinking, oh my God, he did a Madoff on me. So I just want everybody to know that, and you'll get information on Schwab, how to log in, stuff like that. But the more I can talk about it, I think the better it's going to be. Okay. So enough about housekeeping things. Let's jump right into some of the questions I've been getting. Okay. So one question I'm getting quite a bit deals with artificial intelligence. So that's the hot thing right now. So AI is where a lot of these companies start to see their valuations go up drastically if they mention they're doing anything with AI. So, it really just feels like the internet of the 90s. It feels like Bitcoin just 3 or 4 years ago, all they had to say is, oh, I'm doing something with crypto, or we're adding a website to our company, and the stock would fly up. It's the same with AI. And it doesn't mean that AI is not going to be an enormous part of the market going forward, or the economy. It doesn't mean that there's not going to be great companies with AI. Just like with the internet clearly changed the world. Tons of companies end up becoming behemoths because of the internet. So, the same thing will happen with AI. But right now, when you start to jump into the investing at this point, you're just taking a massive risk, because there's so much that's going to shake out with AI. And this is just a tweet from a macro analyst that I follow quite a bit. And he's just laying out how, this new French AI company just came out, and they got a $250 million valuation. It's only been a month. It's only been started a month ago. Don't have a product. Employees are just getting hired. It's like, how do you get that kind of valuation when you have nothing there? All you say is AI. I've got AI going. So, I'm not going into anything with AI. I'll talk a second here about NVIDIA, but, its stock has gone bonkers because, they make cheap chips, and they're saying, oh yeah, they're going to be used as the back end for AI. And so people are just doing ridiculous stuff dealing with AI. It just feels really peakish 1999 kind of stuff. And then it gets to questions I'm getting on tech, like, well, should we, get heavy on tech stocks? What should we do with this stuff? It's going well. I always just say, look, we've got to see cycle to cycle what's really happening. This is a chart of the NASDAQ 100 during the internet bubble meltdown. And the thing is, you can see there's some absolutely massive moves within this bear market. So there were a lot of bull traps. I mean, we're talking big moves, 49%, 28%, 31%, 19%. So the NASDAQ got hammered in 22. And this year it's phenomenal. It's up like 30%. But it doesn't mean that there's a new long-term bull market back. This could just be part of a bear trap. Bear trap. I don't know. But when I dig a little deeper for the markets overall, everything, there's just a very few of these companies that are leading the charge. Again, we're seeing, Amazon, Apple, Microsoft, Google, Tesla, and NVIDIA, and Facebook are really the ones leading the market overall, but especially the tech market. And it's really kind of amazing when you look at it. And the thing is, the valuations are just ridiculous. And I know I talk about valuation a lot, and sometimes when you just have momentum going, nobody cares about the valuations. But over time, you really got to care about valuations. So, when you look at what's going on with price to earnings for some of these high flyers, Amazon's almost a 300 price to earnings right now. NVIDIA is at 215, Tesla's at 59. So you can see you're not really getting a whole heck of a lot of value here. I mean, maybe you could argue Google and Apple look pretty good. Facebook even, they're all three are very good cash flowing companies. So maybe I could look past that. The big one is the price to sales ratio, though. I mean, my God, Amazon's reasonable on that. Their price to earnings are small, but at least their price to sales. So price to revenue is only 2.4, but NVIDIA is at 40 right now. So, that's just ludicrous stuff here. And if you look at the top 7 stocks and of today, the evaluations, and you look at the top 7 from 1999, the peak of the tech bubble back then, you can see like the percentage those 7 stocks make as far as the gross domestic product, which is the entire size of the economy. It's not just publicly traded companies. It's the entire economy. So small businesses, mid-sized businesses, all the businesses that aren't publicly traded are part of the GDP, and they're actually the biggest part of the GDP. But yet you have right now the top 7 stocks have a valuation that equals about 40% of the size of the economy. Whereas even at the peak of 1999, the 7 biggest companies only made up, 24% of the economy, which was still ridiculously overvalued. But you can see it's even crazier now. And it's just, right now we just have a lot of FOMO going on. People are piling into tech funds at this point. So it's not, it's not driven by any kind of rational thought on this stuff. It's FOMO, pure and simple. And that usually doesn't last. And I used this in the last presentation that I sent out via email, just talking about price to sales, price to revenues. We talked about NVIDIA's at 40. And this was a quote in 2002 from Scott McNealy, who was the CEO of Sun Microsystems. So they saw, Sun back in 97, 98, 99. They just saw ridiculous growth in their stock. But he said, 2 years ago, we're selling at 10 times revenues when we were at $64 a share. He goes, at 10 times revenues, to give you a 10-year payback, I have to pay you 100% of revenues for 10 straight years in dividends. He says, that's assume I can get my shareholders to prove it. That assumes I have zero cost of goods sold, which is very hard for a computer company. It assumes zero expenses, which is very hard when you have 39,000 employees. It assumes I pay no taxes, which is very hard, and assumes that you pay no taxes on your dividends, which is kind of illegal. And that assumes with zero research and development for the next 10 years, I can maintain the current revenue run rate. Now, having done that, would any of you like to buy my stock at $64? Do you realize how ridiculous those basic assumptions are? You don't need any transparency. You don't need any footnotes. What were you thinking? So, that's a pretty telling tale from a CEO of a tech company. And again, it doesn't mean that things are going to implode in the near future. Even this could go on for a little while. It did back, but by the 1996, 97, there were already some grumblings out there that tech was overvalued, and we had a bubble going there, but it continued on until 99. So you never know about these things. But sticking with kind of, we have 7 stocks leading the charge. And then, right now, less than 23% of stocks are outperforming the market overall. And a lot of them are mostly tech, or a lot of kind of the meme stocks, things like GameStop, AMC Theaters, all these that are really kind of worthless, Bed Bath & Beyond. So very, very little leadership. Now, does that mean that this, what they call low breath, does it mean that the future results are going to necessarily be bad? I got a question on that. Like, okay, so you have few stocks leading the charge, but what does that really mean? Does it mean that, we're in big trouble? Well, not necessarily. So the top line on this shows 2023, we've got 23% breadth, meaning 23% are above the market overall. And, so far the market's up 12. And then it looks at some other periods, and, they didn't turn out to be all too bad. A little bit more breadth when you get closer to that 50%, you really don't often see more than 50% that are going to be above the market. So these were still, still a lot higher than what we've got today, but, the results weren't all too bad. And this is for for the year. So it's saying, in 2018, we had breadth of 42%, market loss 6. In 98, market breadth was only 36%. So 36% of companies above the market overall, the market's up 26. So it doesn't necessarily mean that, again, in the short term, it doesn't mean much, but longer term, it does have kind of a bad connotation. You don't have many people leading. So John Hussman is an analyst I follow quite a bit. He has what he calls market internal factors. The factors are up there, like where's the S&P relative to its 5, 20, and 40 week exponential moving average? Where's the Shiller cyclically adjusted price to earnings? What's the bearish trend? Like, are there many bears out there right now? Are there not? Are treasury bills higher than they were 6 months ago? And then less than 70% individual stocks above their 200-day moving average. So we're hitting all those things again right now. So he's saying the market internals are really bad. No, it doesn't, mean anything necessarily like huge moves down. It just kind of means like right now, it's probably not a great time to jump in. But you can kind of see some of the periods where his market internals hit these levels. Now, you'll notice it didn't hit it in 08, 07, 08, when we had an enormous downturn. But some of these things he said, like, it just didn't hit during those periods. So it never triggered it. But periods when it triggered it, it was kind of like, take a little bit of a note. Of course, July 99, the market had just a minor pullback and it took off again. So that can happen too. So follow him quite a bit. So the big thing I'm looking at, and I've talked about this a little bit, I'm really big on value over growth right now. And the biggest reasons is both, everything's cyclical in investing. The thing that's hot today might not be hot tomorrow, and vice versa. And growth is extremely cheap relative to, value is extremely cheap relative to growth. And growth has had basically from 09 until through now, with the exception of 2022, growth has outperformed value for the most part. And the deviation between them are very big right now. So I'm really big on value if we're in the markets. But the one I really like is international. And this chart, the little dots are hard to see. I got this chart from an analyst I follow. But he goes back to 1989, and the orange is the IFE. So that's the Developed International Stock Index. So you can see in 1989, international stocks are extremely expensive on a price to earnings basis. So price to earnings is the y-axis here. So it was like 36, 37 for the IFE back then. The S&P 500 was really cheap at probably 17. And a lot of that was due to Japan. Japan was part of the developing market. They're part of the IFE. But you can just see back in 1989 the difference. And I'll look at it today. It's absolutely flipped, where international developed markets are very cheap relative to the U.S. markets. And people will always argue, well, the U.S. market, the U.S. economy is more dynamic, better rule of law, all that stuff. And that's all true. But you have to remember, as an investor, you're buying earnings. When you invest in a company, you're buying their earnings, future earnings stream. So even if the country isn't as dynamic as the United States, if you're paying less for actual earnings, meaning money that they're creating, they're generating profits, and you're paying a lower premium for that, over time, that's going to do you a huge justice. That said, so the Japanese stock market has just recently reached its 1989 level. So think about that. If you were an investor in Japan in 1989, you're just now getting back to break even on a price factor, not necessarily dividends. If you got dividends over that period, that goes to your pocket. But saying from pure price, it's just now getting back to where it was in 1989. And the thing is, if you start to look at it, it looks pretty darn good as far as valuations. This chart just shows you, basically since 1995, Japanese profits have grown 11 times, whereas U.S. profits 6. And then sales haven't been as good. U.S. sales 3 times Japanese sales 1.1 times. But what it shows you is they're really doing a phenomenal job with taking their sales and making the most effective use of them to generate profits. And I think part of the reason that they have lower sales is just their population is starting to shrink. But if they could still generate profits from all of this, then that's what you want, right? Remember, you're just buying future stream of profits, a profit stream. So you also look and see, based on other factors, the market cap of the Nikkei was 590 trillion yen. I don't know the conversion on that off the top of my head. In 1989, December 22, it's 690 trillion yen. But price to earnings. So look at the price to earnings in 1989, 61 times their earnings. Today it's only 12. I mean, that's a good value. And then earnings per share have gone up drastically. So you've seen essentially the earnings are 7 times higher than they were back in 89. And the return on equity is just phenomenal. So we've got some international value right now, and I'm probably going to add an actual Japanese fund. I'm waiting for some sort of pullback. I mean, the Japanese market's up almost 25% this year. If we get some sort of pullback, but I think from a valuation standpoint, concentrating a little bit extra on Japan, even over the rest of international markets, is probably going to pay off, because it's taken them a long time to learn their lesson, but I think that they probably have done it. Okay. So, I'm generally underweight U.S. equities right now considerably. And while I might add some more value back in, I think we're starting to see value pop up. I was not investing in the whole growth thing, because I do think that, as you can tell from this presentation, I think the whole tech growth it's just a bear market rally in my mind. But just to give you an idea, kind of, how I look at the macro picture, which drives a lot of what I do on the investment side. And I've done this before. This is a pretty busy chart. I do apologize for this. Lots of words in here. But I look at, I break the economy up into 4 different quadrants. And where are we right now with these quadrants? So quad 1 is kind of the perfect place to be, the Goldilocks. So you have growing economic activity. So GDP is going up and inflation is muted. So you have inflation, but it was like it was just before, 2020. It's, 2-3%, nothing too bad. As long as GDP is growing faster than that's kind of an ideal environment. Quad 2 is a reflation. So you've got inflation, so higher than normal inflation, but you have higher economic activity as well. So, okay, yeah, that stinks. You got inflation a little bit, but it's not too bad if the economy overall is really chugging along. Quad 3 is stagflation. So that's where you actually have economic growth slowing or going negative, but you still have inflation. So that was, I think, the 1970s. That's also what we saw in 2022 was stagflation. And then quad 4 is deflation. So that's where you're seeing slower or negative economic growth and also prices coming back. And right now, I think from really late 22 into 23, we're starting to move from quad 3, that stagflation, into quad 4. So economic growth is clearly slowing. But we also starting to see prices come back. So that's good. Now, the big question is, are the prices coming back because economic activity is slowing, which is a sign of recession? I mean, deflation is recessionary. Recessions are deflationary. Is that why we're seeing it? Or it was inflation to begin with, just kind of a transitory activity due to the supply chain issues from COVID and the fact that we printed all this money and threw it out there, and now we're starting to pull it all back. It could be that too. honestly. But still, the thing is, we have slowing economic growth and we have prices that are reducing. That's quad 4. So then you have to look and say, well, what works well in quad 4? Typically fixed income, high quality fixed income, gold, and then the US dollar tends to do well. So far this year, none of that's really played out except for gold. Gold's done quite well. It's up over 10%. And then the worst asset classes to have are going to be commodities, equities, and then outside currencies or high yielding credit kind of things. So junk bonds, all of those. Commodities are definitely have pulled back massively this year across the board. From everything except gold and silver have basically pulled back. Equities haven't, though, not yet. So, but still, if you have a slowing GDP and you have prices pulling back, deflationary environment, you don't think equities are going to do well. Maybe right now the equity market sees a Goldilocks. Maybe they think like, all right, well, prices are stabilizing and we expect that will lead to economic growth. That's the only thing I can think of. But when I look at stuff right now, I just can't come away with anything other than deflation. If you're going to get a little more granular on and you want to have stocks, typically the best ones are going to be your, consumer staples, your utilities, your healthcare, telecom, a little bit more boring businesses that are good cash flowing. The worst, typically energy, and energy has done horribly this year. Tech stocks usually do poorly, but they haven't so far. And then, when you're looking at fixed income, you want to be treasuries and long dated, which hasn't done that well yet. So, I just keep looking at it and saying, well, I can clearly see GDP's pulling back and prices are pulling back. Where am I missing something here? But I think it's just one of these, the markets will come to that conclusion. The biggest thing that, and I'll talk about it, the biggest thing, the market's expecting the Fed to start to pull back on rates. And that's what's sort of juicing it right now. But I'll talk about that in a second. But why do I say that the economy's slowing? Well, every leading indicator is heading south, and heading south in a big fashion. Very few areas that are still showing any kind of growth. I mean, and it's all these little things. Like I follow a guy who's his only thing he looks at to give him signs of the economy are RV sales. And he's saying it's getting bad. It's not atrocious yet, but he says it's getting bad and it's heading where it usually does before a recession. So, I mean, there's, the more things that I start to look at, the more we're clearly slowing down here. Now, it has taken longer than I thought. And I think probably the reason is the amount of stimulus that was pushed out in 20 and 21. It's still, maybe it's still making its way through the economy, because right now with rates coming up the way they are, I mean, that's pulling liquidity out, but there must have just been such a massive amount of liquidity that, it just hasn't really hit it yet. So it's a much slower process than what you typically see. Again, we've talked about the inverted yield curve, where shorter term maturities have a higher yield than longer term. And pretty much every one of these are still inverted. Inversions are not good signs for the economy. They pretty much predict recessions coming forward, but they really don't. You don't start to feel the pain in the markets or really even the recession until the Fed starts to reverse its course. So when the Fed starts to bring rates down, the market is excited right now thinking that, well, the Fed's, they paused their rate cut this month. They just met this week. So maybe they're going to get more accommodative because prices have pulled back due to their increase in rates. So the markets are thinking if rates come back down, it's the party time, put the punch bowl out, spike it a little bit and let's have a party. But the problem is usually once the Fed really actually starts to cut, and probably the only way they're going to cut is if we're seeing economic struggles. And if you look historically, once the Fed starts to cut, that's actually a horrible sign for the stock market. That's when you start to see the stock market have some serious struggles. And you don't really feel the effects of the recession until the yield curve inversion starts to flatten out. So when the longer dated bonds start to yield at least the same as the shorter dated, once that inversion starts to go away, and then we might go back to a normal yield curve, that's when you see the effects of the recession. And also, in this case with the Fed cutting, that's usually when the market downturns have happened. So you can kind of see back 2000 when the Fed started cutting rates, that's when the markets really started tanking. Same with 07, 08. And even if you go back even earlier into the 80s and 70s, you can see the same thing happen. So, I mean, what I would look for is if this inversion starts to cure itself a little bit, or if the Fed does start to backpedal, it's probably really not a good sign. I mean, the ideal thing is if rates can stay where they're at, then, and the market continues to do fine and the economy does all right, well, that's the best way to do it. That's honestly the best thing that we could do, even though interest rates are higher, if you could still function that way. So I've been saying for a long time, the Fed's going to keep rates higher longer than what people think. And so far they're definitely doing that. And I think they're going to stay there until something breaks, till we feel some real pain. The other big question I get a lot is, how can I sit there and say that I expect a recession when unemployment is really great? Anything sub 5% is really a good unemployment rate. And, we're right around the 3% inflation rate. But, I just kind of alarm people. This is a chart I saw on CNBC going back to 1948. If you look at every time a recession has started, just about every time we've been below 5% unemployment. There's a couple periods where we were, the 70s, 80s, we had high unemployment, and then we went into recession a couple times. So outside of that, for the most part, when you go into the recession, you've got very low unemployment. If you look at 2000, the unemployment rate was, sub 3%. Even the same with 07. And then in 2020, I know that was a weird thing due to COVID, but we had very low unemployment at that point as well. So you can't look at today's unemployment and say, well, there's no way we're in recession because of that. One of the figures that I look at, I said all these leading indicators across the board are looking bad. One leading indicator is just the 12-month change in unemployment claims. So that's just people who start to go on unemployment, and that's going up right now. So and again, it doesn't mean the unemployment rate is necessarily going to go up yet, but if initial claims, people filing for unemployment, is going up, and the change over the past 12 months continues to be more people filing, that's a bad leading indicator. And then the other thing that's just kind of odd with payrolls is I did a whole presentation on that, but the headline payroll numbers that everybody talks about, non-farm payroll reports, they've just been way off compared to either ADP, which, the payroll company, they do one themselves. And also the government, the Bureau of Labor and Statistics also does what they call a household survey. Household survey, they call households and say, do you have a job? And if they say yes, they're employed. If they say no, they're unemployed. But there's about a $600,000 or 600,000 person difference between household and then the headline non-farm payroll report. So one of them is wrong, or maybe somewhere in between, maybe it's the difference is 300,000. And then ADP is showing a very different picture too. So I don't know what's going on, but the better than expected streaks for these non-payroll reports is kind of off the charts right now. So I don't know what's going on. I don't know if it's just they're tweaking numbers a little bit here, a little bit extra, or what. But we'll really see what's really going in there. But another way to look at employment too, or at least hours worked, is probably the better way to look at it. Payroll taxes are coming down, so personal taxes are coming down. So if people are paying less in taxes, it probably means they're generally not making as much money as they were. It could be unemployment. It could just be that they're not getting as many hours as they want. I hear that quite a bit from a lot of people that are on an hourly rate. So whether it's at a Starbucks or somewhere else, they're not getting as many hours as they would like. So that could be a problem. And then the last one, I just threw this out there, but Deutsche Bank has one, their probability model looking at leading indicators. And, they're saying it's a pretty high probability for recession. I don't know if it's going to happen, but at least right now, my macro indicators are kind of saying it is, but it is taking a lot longer than what I thought it would. And I think, I still see them heading south. If they start to turn up, I'll change my mind, and that could happen. Anything can happen. All right, so finish off with my usual lawyer say hello. That's the disclaimer. Lots of fun there. And let me shut this thing off. Okay. So let's see, any questions? Good question. So is it going to be wiser to invest in companies that would greatly benefit from developments in AI versus AI companies directly? How do you evaluate those companies that would benefit from AI? To the first question, absolutely. That's usually how most of the money is made. It's not necessarily the company that produces the AI product or the internet product or whatever. It's the ones that utilize it the best. Whether it's through cost savings or it's a company, probably Google's trying to develop AI. So since they're already pretty lofty in size, maybe they end up being the one that develops some technology. It's usually back when we had the marijuana stock craze 5 or 6 years ago, and everybody was asking me, should we invest in marijuana? It's like, these little marijuana companies, you can't really evaluate them. You don't know where they're going to be 5 years from now. But watch the big boys, watch the Philip Morrises, watch the Altrias, watch, the companies that it's just this hop, skip, and jump over to that industry. So, Google, obviously search engine, it's probably an easy, seamless jump over to incorporate more AI. As far as how do you evaluate what companies are going to benefit from AI, that's hard. That's the $1 million question right there. I think every company in some fashion is going to potentially benefit from it, unless they take over the world and all that. But everything. Financial companies should see some benefits from it. Pretty much every industry in some fashion. Maybe not like typical commodity companies or food companies. Utilities probably won't, but a lot of firms are going to experience it, probably in ways you wouldn't imagine, are going to have some benefits from it. But that's the harder question. Like, how is this thing really going to develop? Right now, it's really more of the big things, the ChatGPT and the one that Google kicked off. I can't think of the name of it off the top. Bard, Google Bard. It's really more of an enhanced search engine. You can get more information. That's really all it is at this point. So it's going to be something to track and watch. I don't have a good question or a good answer to that second question yet, but everyone's going to be affected. I don't know who's going to have the best impact from it, though. It's probably going to happen in ways that we don't really anticipate. But as far as your first part, you're absolutely right. you're better off figuring out who's going to be kind of a player in this, but not a pure blood AI company, because a lot of those are going to go away. So you get just a massive rush into it, just like the internet. Everybody wanted to get an internet company going, wanted to get venture capital funding. It's the same thing right now with AI. So a lot of them are just going to go by the waysides. And at best, they might get picked up and purchased by a Google or Facebook or something like that. So, yeah, I guess that's the only question. Okay, well, I'd like to thank everybody for checking in, spend a little bit of time here. And again, if you can send me questions, I love getting the questions from everybody, because it kind of drives my research a little bit. I know that if you're asking me that question, then there's probably a lot more people. So, taking Charlie's question there, I'll probably try to read a little bit more AI. I'm already trying to do that. But so yeah, just keep sending me the questions. So everybody have a great weekend, and we'll see you in a couple of weeks. Take care, everybody.